You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That rockin' tune means it is time to rock out once again with TWIFO This Week in Futures Options, the program where we break down what's going on this week on the futures options side of the fence. That could be energy, that could be rates. That's going to be a lot of equities these days again, because that's still moving the needle, I know, for a lot of you guys out there. Maybe who knows what's going to sneak on there. Maybe FX, lean hogs, you never know. Got to tune in every week to TWIFO. That's what makes it fun. We don't even know before we get the show ready what the heck we're going to talk about. That's what makes it fun. We try to let the markets dictate where we go. And, of course, you guys as well with your questions and comments. Keep them coming. We love to hear from you. You guys can join us live, as always, every Thursday, 1:30 p.m. Central, provided there are no internet outages out where you are. I know some of you having issues with all of that stuff. Speaking of issues, he had some to keep him from joining us last week, but now he's back and ready to talk some TWIFO action. My compatriot, my partner in crime out there, Mr. Sean Smith, the Managing Director of Derivatives Licensing over there in FTSE Russell land. Mr. Smith, welcome back to TWIFO, sir. It has been too long.
Hey, Mark. Thanks for having me on the show. It's great to be back. Crazy times continue in the marketplace, so it's good to be back. I look forward to having a great show today. Yeah, we've been isolated here doing the home version of the studio here, but you've been kind of traipsing about these here continental United States, sir. What the heck have you been up to since the last time you and I chatted, sir? You know, I've been doing the same work from home kind of studio, but my travel has been electronic, via phone and via email mostly. I did shoot to Philadelphia to get one of my sons home from college quickly in the past week, but wasn't market related, other than I was on the cell phone during that drive quite a bit with work and questions with clients. So There's no rest. There's no rest for Sean Smith at FTSE Russell.
No rest. And everybody's home. Everybody's safe now. It's all good in the family land there, sir?
Almost. We've got one more son in Connecticut that we're working on getting him home. He'll be home next weekend.
Glad to hear it. All right, let's get rolling. As I like to do, Sean, I'll let you pick where we begin our journey today. We like to break down, of course, the movers and shakers. You guys can find this report as well as a bunch of others for yourselves. CMEgroup.com/TWIFO. You can generate a report on whatever the heck you want. If you want lean hogs, no one's going to stop you. CMEgroup.com/TWIFO is the place to go. Don't have to wait for us to break it down. You guys can do it yourselves. But that said, Sean, where should we begin our journey this week? To the dark side or to the light side, sir?
I got to tell you, I said I was making the comment that I've been really watching the performance of small caps versus large caps, and of course I watched the Russell 1000 versus the 2, and the large caps have been outperforming the small caps quite a bit, and boy, that Russell 2's been on a volatile tear. So I got to look downside because I still see Russell 2 struggling from coming out of this, but I'm excited to kind of talk about some great opportunities to trade it. So I'm going to go dark side.
Wow, look at you getting lured to the dark side. Well, it's kind of hard to argue, especially when you see what the number 5 is on our bottom dark side list. By the way, this overall movers and shakers report looking very different than it did last week. That's kind of been the case every week. It kind of flip-flops, listeners. Now we're flip-flopping back to the dark side. Last week, of course, there was a lot of green on the screen. We were in the midst of that kind of near-term rally, I suppose you can call it. Now we're on the other side of that. And, of course, the things that are rallying this week are the polar opposite of what was rallying last week. Last week, these names were selling off hard. Now they're in the rallying camp. So mostly energy, now light side, and everything else dark side. So it's very much flipping up the script from this week to last week. Let's break it down. The bottom of the dark side, the bottom of our dark 5, which I guess is where you want to be if you got to be in that list, is, of course, Sean has mentioned it, the Russell 2000 off 9.11%. This is from our last show last week, so exactly a week ago, off 9.11%. So small caps taking a bit of a drubbing out there. I think we got some listener questions about that a little bit later, so we'll get to all that, of course, in a bit. Number 4, the rest of these on the dark side are kind of interesting names, not names you usually get a chance to talk about. Number 4, feeder cattle, off nearly 11%, 10.98%. Number 3, live cattle, the other side of that, 11.2% to the dark side. Number 2, lumber, off a whopping 17.39%. And number 1 to the dark side is our old friend lean hogs, just not looking good, off 23.16%. All of this madness with the pandemic, obviously wreaking havoc on the livestock side of the business out there, and that's being impacted, seeing in these numbers out here this week. Number 5 to the upside, so the bottom of the upside here, the old Ultra Bond, up 2.8%. Number 4, rough rice, up about 3.5%, 3.56%. Number 3, our old friend WTI, bucking the trend to the upside this week, up 3.84%. It was getting crushed last week. Now, of course, some talks helping to bolster, perhaps, the optimism a little bit for what's going on out there. Number 2, good old RBOB, other energy name that has been shellacked of late, up 9.18%. And number 1, with the bullet to the upside, is the Eurodollar, up nearly 14%, 13.91%. Before we get into some of those complexes, let's break it all down for the month and indeed the quarter. We were just talking on the option block about what's been going on. A record month for the overall options and the equity options side of the business. OCC reporting record numbers. Similar news coming out of CME land for March and indeed for Q1. The CME reporting today they reached a record ADV of 32.1 million contracts in the month of March. That's up 68% from March of last year. So no matter where you look, on the equity side, on the CME side, futures options, wherever you're looking, the numbers are just crazy town, I think is the technical term. And again, all that is being done in an entirely electronic market right now, listeners. So guys are running their trading desks and their trading firms from at home on their broadband and still managing to keep up this kind of pace of volume. It's kind of insane when you think about it in those terms. The Q1 ADV was a record 27 million contracts. Again, ADV, of course, listeners, average daily volume. That's up 45% from Q1 of last year. OI, so the open interest at the end of the month, also 123 million contracts. Now, that's combining, of course, futures and options and things. Let's break it down a little bit by complex rates. Leading the charge, their ADV was 13.8 million contracts. Let's think about 13.8 million contracts. Insanity. Up 34% from last year. The equities, number 2, 6.5 million contracts a day. That's up 106%, so effectively doubling from last year. Overall options, just total options ADV as well, it's 5.4 million contracts. That's up 41% from last year. Breaking it down by complex again, energy ADV, 3.2 million contracts. That's up 38% from Q1 of last year. The ags ADV, 1.5 million contracts, up 9%. Interesting, ags overall doing about half the volume that the energy is doing. They're up 9% from Q1 of last year. So ags have kind of, as you mentioned, they haven't been in our top 10 to the upside or downside a lot lately, or top 5. They haven't really been lighting it up too much. They were a big story on the trade war. Now, coronavirus, they haven't been exactly lighting up the tape, so they haven't had a chance to do a ton of ags here on the show. We'll see if we can maybe correct that with maybe some of your questions here this week, because they're not in the top 5 again. Let's see, outside of our old friend getting in the rough rice category, but not a huge option story there. Let's see, foreign exchange, ADV 1.1 million contracts, up 22%. Metals, 889,000 contracts, up 51% from last year. Some other interesting nuggets coming out of CME land here. Total volume, over 25 million contracts for 15 consecutive days. That's a record in CME land. ADV of futures, of Eurodollar futures, that's a record as well, 5 million contracts. The E-minis, the micro E-minis, those are the ones we talked about, kind of just come out of nowhere to just blow the doors off it out there. Their ADV has been a record as well, 2.3 million contracts. WTI futures setting a record as well, 1.9 million contracts. And gold futures, also a record of 471,000 contracts. That's a lot to digest there, Sean. Before we get into all things equities in your neck of the woods, any of those numbers jumping off the page at you, Sean? Any of those numbers surprising you? Any of those complexes out there as we're breaking down a historic Q1 and indeed a historic month of March over there on CME and indeed across the entire options and derivative spectrum, Sean?
I look at these numbers every single day. And of course, I'm pretty much equity focused when it comes to our products. I think the interesting thing is that, one, the volume's just massive on CME and CBOE and during these volatile times. Two, it's the open interest stays strong and growing. CME's open interest in the Russell franchise is, just around 600,000 contracts. That's up substantially. Volumes in the Russell futures is up just about 50% year over year from last year. And RUT options on CBOE are up 40% year over year. So we're seeing growth in volume. We're seeing growth in open interest. And, these markets usually, hate to say something negative, but, there's usually fatigue during these high volatile times where you see people taking stuff off and there being some deleveraging, but you're not seeing that. So what that tells me is what everyone in the news has been kind of saying, and market analysts, including ours at FTSE Russell, that this isn't a financial crisis, it's a health crisis. And there's still investments that need to be made and need to be managed, need to be hedged, and there's active trading. So it's just an incredible time to be watching these markets.
Yeah, I think the technical term is insane. We're rallying off weird news like coming into today. Let's get into equities land. We were just talking about it. Coming into today, we saw yet again more historic, just cataclysmic news from an economic perspective, let alone on the healthcare side. That's another issue entirely. Just on the purely economic perspective, the jobless claims numbers coming out last week was a terrible record of 3.3 million. Now double that, 6.6 million. These numbers are just atrocious. 10 million people in the last 2 weeks, pretty much filing for some sort of unemployment benefits out there. That's not a good look for the economy. Economists backing those numbers out to saying it's going to be at least 10% unemployment, if not more, going on out there fairly soon. So these numbers were pretty dire, and yet coming into today, we were rallying pretty hard. Most of the major indices were up over 1.5%. Coming into showtime now, it seems like a lot of that rally has mitigated, as you might expect. These numbers are kind of just weighing on everything, let alone the growing catastrophic death toll coming out of places like New York, also continuing to weigh on these markets. NASDAQ has now turned negative for the day, so giving up those gains and turn into the dark side. S&P still positive, but only ever so slightly, up about 1/3%. The Dow flirting with unched pretty much on the day. So most of those have given up their gains now to the upside out there. Of course, our old friend VIX Cash was at a 52.5 coming into the show not too long ago. I put it down about 7.5 points. Now it's about 54. So it's ticked up a little bit, so it's down about 5 or so points, maybe 6 points from where it was this time last week. Our old friend VVIX, a.k.a. the volatility of volatility, still just incredibly elevated at about a 151, but that's down from the astronomical levels it was last week, let alone the week before. It's down 16 handles from where it was this time last week. Again, 150 in the VVIX. Still, you got to pay attention. Volatility is moving, and the markets are moving. Again, we've had almost a 2% swing just in the markets already today. It's not quite the 4% daily that we saw for a while there, which is why volatility is coming in, even though we're still moving. The vol math at the end of the day is pretty basic. If you're not moving X percent, it's not going to translate to Y level of volatility. So upside, downside doesn't really matter, just as long as you're seeing some movement. We're seeing movement, but not quite enough. So hence vol is coming in, but by no means is it not still a volatile environment out there. Don't mistake this for quiet times. And just to hammer that lesson home, our old friend RVX, a.k.a. the VIX of the small caps, is at about 61.3. That puts it down almost 4 handles from last show, about 3.7 out there. Actually, that's ticked up now as well. That's up to about almost 63 since the start of the show, about 62.9. So that puts our little spread here of the VIX versus the RVX at about almost 9 handles. That's astronomically wide, and again goes to show just how crazy small caps have been of late. There's a reason why they're leading the show a lot these days. They're one of the most volatile things out there. It just, the story is, I think, insane, for lack of a better term. And the vol, I think this spread has not been this wide in some time, and it shows how much RVX and just Russell are moving, are leading the markets to the downside and to the upside. So again, this narrative that small caps don't move in these macro-driven environments, it's kind of getting the doors blown off it right now. Every week, it's we don't even have to look. It's Russell 2000 leading the equities, and indeed usually on our most actives, a week in, week out as well. Before we get to Sean and his thoughts on what he's hearing out there, let's also get some of you guys on here as well. We've been asking you guys questions. We've seen some weird, I think, safe to say, bounces out there, particularly last week, a big rally. Coming this week, we saw some rallies, including today. It was yet another weird rally day out there. Earlier this week, we asked you, right as the S passed 2,600, is this for real? Are you guys buying this? And more specifically, are you guys buying this in a little bit longer term? So let's go out a month from now. What are you feeling about these levels? We use the S&P, but pick your poison. It could be Russell. It could be any index you like, the Qs, whatever floats your boat out there. A month from now, were you feeling effectively higher or lower? And so a lot of you guys coming in, and not surprisingly, as our audience tends to be a little bit cynical out there, they're fading this. Coming to Showtime, it was about 63.3% of you saying we're going to be lower. It's going to be a bit of a dead cat bounce. Right around this level, so right about unched a month from now, is nearly 17%. Higher, only 14%, about 14.2%. And nearly 6% of you, 5.8%, saying I'm in cash. I don't care. I'm safe for now. That's what I care about. So, Sean, a lot to unpack there. What are your thoughts on these insane vol numbers, these insane movements we're seeing out in the Russell 2000? What are your thoughts on what our listeners are thinking from an overall equity outlook perspective? And also, like I said, you've been on the cell phone even when you're off rescuing your sons from college. You're still on the phone talking to market participants, talking to end users. What are you hearing from these folks right now in these somewhat unprecedented times, sir?
Well, there's a lot of things that folks should be thinking about. And before I do that, there's a couple of things I just want to share with the listeners, and that is, on our website, FTSERussell.com, we have what's called a market hub, which is mapping the impact of the coronavirus across various indices and across various asset classes. I strongly recommend you guys go to my website and check this out. It's FTSERussell.com/coronavirus-mapping-impact. Mark, I'll send you a link to this spot on our website so that you can broadcast it out to the listeners, or they could just, email me directly, and I'm happy to send them the link as well, at estimate at FTSERussell.com. Happy to send it. But there's some fantastic analysis from our global markets research folks, Philip Lawler and Catherine Yoshimoto. They both do a fantastic job of doing tremendous market analysis on various indices, small caps versus large caps, the FTSE 100 versus the 250, because we're FTSE Russell. So there's looks at other asset classes. It's just a tremendous place to go and find a lot of information regarding the markets and how to think about the impact coronavirus has had on various asset classes. And it would be definitely worth your listeners to check that out. But back to the markets, Russell 2000 is volatile, and we talk about this a lot, but yet you have to think about the weightings of the index itself as to why Russell small caps are taking those much greater swings and struggling to the upside today. But again, as economic things change, you'll see the Russell 2000 gain momentum to the upside at some points, and other events will bring it quicker to the downside, as we've all watched. But the small cap index, Russell 2000, is primarily weighted, or heaviest weighted in financials and bank stocks. So they're all very interest rate sensitive, right, in the marketplace. And what's happening right now is rates are at historic lows, right? So that is taking a dramatic impact on the heaviest weight within the small cap stock. So large caps are heavy in the technology, where you're seeing stronger performance from technology stocks recently. So for those kind of reasons, you'll see the more volatile swings within RVX, and that's why you see such a decrease in VIX versus RVX volatility in terms of the two volatility indexes. But again, there's just tremendous volumes going through CME right now and through CBOE. Liquidity is not an issue whatsoever. But very exciting to see that key interest. Open interest number is something that has really jumped out at me as that number increases. A real sign of confidence in the market from an investment perspective. Open interest is folks that are taking those long-term positions. Some of those, yes, are hedged in options, but others are directly indications of being in the market to have investment vehicles at this time. So it's a fantastic confidence building number to see those open interest numbers at both SIBO and at CME growing.
Yeah, unfortunately, our audience is not sharing the confidence here. Like I said, they're fading this market pretty aggressively. A, does that surprise you, Sean, that our audience is looking for more downside in about a month out from now than we're seeing right now? And then B, like I mentioned, you're kind of on the horn with a lot of these firms. It's been unprecedented times. A lot of these guys are probably calling you from their home office right now, trying to run a trading desk or a trading firm, whatever it might be, from a home broadband connection. I always used to joke here on the network that we're approaching the levels of technology where you could effectively run a fund, if not a small trading desk, from your smartphone on a beach somewhere. Well, people are not exactly on beaches, but we're seeing similar setups right now. People have to do out their home setup. Some of them have their trading turrets set up, and most of them, they don't. So it's just crazy times. And I mentioned those kind of numbers at the top of the show, Sean. Are you also surprised, like I am, that the market is able to just handle the depth of the volume it's putting up right now, despite the fact that things are as scattered as they have ever been in the history of the market, Sean?
It's as I talk to lots of the bigger trading firms out there, and I talk to the exchanges and I talk to the clearing houses within those exchanges, OCC and CME's clearinghouse. It's something that our market participants and our exchanges have been preparing for a very long time. I'm not saying preparing for the coronavirus, but I know that they've been preparing for scenarios where there's going to be these remote scenarios in the marketplace where there is going to be a a remote scenario where people are going to have to trade not from the office, but from various places. And from the trading community, I know that a lot of trading firms have been investing a lot of money in this continuity type of scenario where they can continue to provide markets remotely. And also, the exchanges have been clearly working on this for many, many years, and I'm not surprised at all that things are running smoothly. It's been preparation, it's been testing, it's been practicing, it's been having drills, it's been having a lot of this preparedness that has enabled our markets to stay liquid for those that need to be in and out of that market. So, my hands are actually applauding everybody involved that the market has been as resilient as it is. Now, in terms of the market thinking the market's going to be down in a month, I'm not going to even venture a guess in the direction of the market because there's so much that our finance, our banks here, our central bank here in the United States can do, and our government can do, the global economy can do, not to mention what all the components of the index, the companies can do themselves as well. So I actually think that there's going to be volatility in this market until there's signs that this health crisis is peaking and the numbers start looking better in terms of a healthier country and world. So I'm waiting for that to happen, and I'm hoping that happens sooner rather than later, like everybody.
Yes, I think we're all with you on that train there, Mr. Sean. Speaking of trains, let's keep this one rolling on out into the other product you guys are all at Twitter about. Of course, we're going to talk crude, we're going to talk some energy. Like we mentioned, it was dark side last week for crude. This week, firmly on the light side, we had RBOB number 2 up 9.18% since last show. WTI up nearly 4% at number 3 out there in our top 5 to the upside. Of course, a lot of that coming on the news that perhaps there will be a détente in this just head-scratching price war between Saudi Arabia and Russia. I get the end goal is to squeeze a lot of U.S. shale oil producers out, and certainly that is happening. We're starting to see some Chapter 11 filings from those producers over this course of this past week, so the impact is already being felt. Once you get much south of that $40 a barrel price, doesn't make a lot of sense for a lot of these shale producers to keep pulling this stuff out of the ground. But whoever thought that we'd have a scenario where we have a global pandemic, which is already catastrophic for energy demand, then on top of it, we would have this accelerant of a price war between the Saudis and Russia. It's not a scenario I don't think anyone ever envisioned, and it would continue. It would continue as this pandemic continues to grow and spread. The price war would continue out there. So that's what we have. So hopefully, perhaps, rumors of a détente, Saudi Arabia calling for an emergency meeting of OPEC. Trump also out there talking up some cuts, whether he can make that happen just by talking. I don't know. There's also rumors about some tariffs and some other things. They've been talking for a while here in the U.S. about loading up our strategic petroleum reserves. That'll certainly give a little bit of a cushion out there. But in general, it's some of the most bullish talk we've seen in crude and indeed in energy for quite some time, and we're seeing that reflected out there. If you guys want to see it for yourselves, of course, cmegroup.com/TWIFO. Hit that drop down, go out to energy, hit WTI, and you can be off to the races, just like me. And you could see out there, if you were going to do such a thing, that right now nearly 30% of the paper out here is coming in this May contract out here, 29.9% this week to be precise. Let's look out here to what the most active contract is out here in WTI. Yeah, it looks like it is the May 30s. So not that long ago, 40s seemed pretty catastrophic to the downside, and now we're talking 30s, and they seem pretty aggressive and optimistic to the upside. So, how the worm has turned in the span of a couple of weeks out here in WTI. The big print, like I said, the May 30s, 10,633 of these throughout the week. It's like it's been a lot of back and forth. The lion's share actually today, which is not surprising. Nearly 4,000 of that over 10,000 coming today as we're seeing this big rally happening today. So I don't have OI numbers for today. The rest of the week, the 30s were kind of unched from an OI perspective. A lot of back and forth on that strike. Again, it wasn't a lot of upside momentum until really today. Number 2 out there are the 20 puts. So folks still worried about maybe breaking to the downside, maybe also taking some of that off as we're rallying, maybe the concerns mitigating. Let's see how the OI is faring out here. 9,039 to be precise. The lion's share also happening today. And in fact, looks like a good chunk of this paper this week is closing things out. I'm going to wager with today's rally that today's paper is also probably biased towards closing. So maybe for the near term, the concerns about that 20 strike a little bit in the rear view mirror. Then we go out to the 35s also in May, nearly 8,000 of those. Again, almost 5,000 of that 8,000 coming today, so no real OI numbers on that, but clearly a good pop. That's pretty tied, close to tied, I should say, with the 10 puts. Yes, the 10 puts out in May, listeners. 7,676 of those traded this week. Most of that opening, the big day was Monday, 5,000, so over half of that paper, 2/3 of that paper come in on Monday. The rest kind of scattered throughout the week, and that was opening on Monday as well. So someone opening to the downside. Doesn't seem like that was a vertical because the numbers don't line up. Could be a bit of a funky ratio, in which case it'd be a pretty heavy ratio skewed towards the 10 side of that equation, 2010. But interesting stuff out here nonetheless. Maybe a 15, 10 vertical was going up because it could be a 1x2. About 2,400 of the 15s went up and 5,000 of the 10 puts. So perhaps a bit of a 1x2 out there. Either way, 10 puts fairly active. Let's scroll around a little bit before we look at what the vol numbers were telling us for May out here. 50 calls were also pretty active out there in D's 50s doing 7,046 contracts this week. Pretty much all of that on Monday, or good, almost half of that, 3,100. Nothing going on today, only 102 today. So the rest were scattered on Tuesday and Wednesday. A good chunk of that opening. So someone perhaps the worm turning out here. Today the worm is turning. It never really has been that long-lived out here. Let's see what we're seeing from a skew perspective out here now. Vol, of course, is going to be up a bit as well. Remember, it doesn't matter if it's upside or downside. There's movement happening. So vol is up about 5 handles. Still in this May contract, it's at a whopping 154 in the at-the-money implied. So it's pretty, the technical term, I believe, is juicy out there in WTI. Not quite as juicy as it has been, but pretty juicy nonetheless. Let's look to the skew out here. Last week, the puts were 11.1% rich to the at-the-money. This week, they are almost 16.5% rich. So the puts, even more bid, which is kind of intriguing. The calls, 7.3% rich, or should I say cheap. This week, 13.5% cheap. So the call wing coming in. Now, in a rally, you might expect to see that. Usually if you move up, all things being considered, the calls are going to probably come in a little bit. The put's going to get a little bit bid as that rotation tends to happen. That's usually, though, out in a large, broad equity index where you see things like that. And if it's a sharp move like this, like it is today, usually you see the calls would stay a little bit firmer as you're kind of blowing through some unexpected strikes to the upside. Yet we're not seeing that. The calls coming in, which is interesting and perhaps a little concerning to all of you out there looking for a bullish sign out there in WTI right now. The calls not exactly showing the love, perhaps. Let's go a little bit longer term. Let's go out to D's and see what's up out there because there was some heavy call activity on those 50s. And the call, same deal. Puts more bid out here. The puts were about almost 14% bid last week. This week they're almost 21. So the puts getting more love and the calls getting cheaper. The calls were almost 10% cheap at the money. This week they are 11.1%. Maybe those 50 calls were an overwrite. Taking advantage. We have seen that before, taking advantage of any blip to the upside. We've had guests come on and say this time and again over the course of this past year, any move to the upside is an opportunity to fade aggressively out here in WTI. And it does seem like, at least in the near term, this paper is kind of leaning that way as well. I was hoping maybe, just for all you writing in who have the bullish side of it, that you could have an argument. And it'd be nice to change the narrative a little bit out here in WTI. Doesn't seem like the market, at least in the near term, is too hopeful of much beyond what we've already seen out here this week. Again, we're not seeing much lift. I'm looking across the spectrum here. Not a lot of love for these calls, kind of across the board, listeners, which is perhaps a little bit surprising out here. Let's see. Mr. Sean, I will give you pride of place. We could try to squeeze in a few more complexes, but we also got some listeners out there who's got some cues for us. So what would you want to do? You want to squeeze in some more complexes first, or you want to get the rest of the show, pretty much get the listeners on here?
Let's go to listeners. I'm a big fan of always answering questions of our listeners. They keep us going. They keep us excited. They keep us challenged in the market, and we usually get some great questions. So let's go there.
Yeah, especially these troubling times, I like to spend a little bit more time. People need to be talked off the ledge. You guys have a lot of questions. Obviously, you're hitting us up all the time. So let's get to it. A little bit of an extended dose of your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/The Options Insider, stocktwits.com/Options Insider, or via questions at theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody, welcome to your segment. I mean, the whole show is your show, but this is your segment where you get to dictate what's cooking out here. First off, I mentioned our audience was fading things on that Twitter poll out there, and those numbers still looking pretty dire, as we said, still about 63+% fading this rally. We got our longtime listener here, Mr. Mark Brandt, chiming in. He says, anybody not buying is fine with me. A kid in a candy store scenario. No joy in a pandemic, however. Well, yeah, definitely with you on that latter portion out there. And I can see people being circumspect about buying at these levels. Definitely pick your poisons out there, listeners, because we've seen, like, even today, the rally was very short-lived, and now it's back again. Now S&P is up 1% again. So we're in very, very strange times, listeners, I think, to put it mildly out there. Let's see. We've got a kind of a combo question here, Sean, from two different listeners. They're kind of related, so we kind of put them together. First one from STIPOD. Let's go with STIPOD. STIPOD wants to know, have you heard about any more market makers blowing up out there right now? And then a similar question from Eric. He wants to know, what was it that forced CME to liquidate Ronin Capital last week? Was it just a risk issue? Of course, STIPOD is referring to, and what Eric is mentioning is, of course, CME had to liquidate, unfortunately, Ronin Capital, which is kind of the offshoot now of what used to be Stafford Trading, which I and many other people traded for back in the day. They sold off to TD, one of the more infamous sales in the history of the options business. You hear many stories about TD perhaps wanting to sell that back a few years later, but they ended up taking what was left and spinning that off into eventually becoming Ronin down the road. And now Ronin being liquidated a couple of weeks ago, which was kind of a surprising news, I think, to a lot of us out there, but not maybe that it was Ronin, but not surprising that we heard that liquidity providers were having issues. This is a notion I've addressed on the network many times over the years. There are fewer liquidity providers out there really every year, and now we have this unprecedented scenario of there's only a handful of liquidity providers, and on top of it, we have this unprecedented market of everything's electronic, everyone's trading from disparate locations. It's kind of a double whammy. On top of it, we have these, when they blew out, they were on the cusp of these just kind of unidirectional markets. They were just selling off day after day after day after day. And if you're out there as a liquidity provider, that kind of one direction type trading is some of the more dangerous stuff you can really encounter. So what a liquidity provider really needs, hopefully, ideally, is a two-sided market to get into and then get out of stuff. If all you're doing all day is selling puts and buying calls to customers over and over and over again, and guess what? That's what you're doing when the market is off 4% a day, if not more. You're just doing that over and over and over again. At a certain point, it's just too much. And I think that's probably, again, I haven't dug into the specifics on Ronin. I have to guesstimate it's probably something along those lines. There could have been other issues there as well. Perhaps there was some less than judicious use of capital on their part. Again, I haven't had a chance to dig into all the question marks surrounding that. I think these recent rallies have helped quite a bit to put a little bit of two-sided paper back in. Now, if you keep rallying every day, that won't be good in the long term either. You can have upside crashes as well. But in general, a little bit of releasing of that pressure valve, vol coming in a little bit, rallies happening. I think that has helped to mitigate some of the pressure out there on some of the market makers. But that said, Sean, you're out there talking to these trading firms day in, day out. First off, as STIPOD wants to know, have you heard of any more market-making firms outside of Ronin going under in the last couple of weeks? I have not, but maybe you've heard of some I have not. And then B, do you have any more insight into what happened with the Ronin folks, as our friend Eric is asking, sir?
Just a comment that our exchanges and clearing firms of these exchanges do a fantastic job of being that in clearing firms that are members of the clearinghouses, who are the first wave of risk management. First, you have the trading firm itself managing the risk. Then you have the clearing firm managing the risk as well, and it's aggregated because they clear more than one customer. And then third, you've got the clearinghouse, who is also looking at an overall risk portfolio of all of the members. So there's a tremendous risk environment in the futures and options universe, and it's why during the crash of 2008, you didn't hear of any futures and options explosions because of the risk controls that our exchanges and clearinghouse and clearing firms have in place. It's a fantastic way of managing the risk of the industry. But, clearinghouses and clearing firms do a really good job. This stuff stays very, very confidential. Nobody really shares which firms are blowing up or have blown up. It's Ronin was announced. They were a tremendous firm, lots of really good people there. I don't know. I'm not even going to speculate. There's been lots of speculation what happened there, but it's always unfortunate to see. But I still take my hat off to the guys that are managing the risk of our industry, and they do such a good job of making sure that one, clients are safe. Two, that the industry stays risk managed in such a good control fashion to minimize this type of scenario. So it's one of those things that don't get broadcast with all the details. And I think our exchanges do a really good job and clearinghouses do a really good job of managing that risk for us.
So the good news is you haven't heard about any other firms going under or having issues since the last time we chatted, Sean.
No, I'm never on the receiving end of that type of information. And frankly, I actually don't even look for that type of information. I'm a glass half full kind of guy, and hoping that our liquidity providers do what they do, getting in and out of the market, stay hedged. One of my favorite expressions is buy puts when you can, not when you have to. That just means just don't get caught in a big move, being short something. And it's a trading philosophy I've always lived by. So I have not heard. I don't ask. I am always conscious of risk management and our exchanges and our clearinghouses policies in regards to risk management. I'm very cognizant of that and very respectful of that. But no, I don't. I have not heard any rumblings of other firms.
So that's a glass half full. There you go, Mr. STIPOD and Eric. We have not heard of any others, which is good. I think some of the recent market movements are delivering a little bit of relief. Some of these firms out here. TAC3 wants to know, how does vol in the RUT compare to SPY right now? More or less? Well, the RUT is, of course, RVX. SPY, vol is going to be VIX. So let's just look at what we talked about earlier in the show here. That spread, as of a little bit earlier in the show, the VIX was at about 52.5. The RVX was at 62.9. At the time, the VIX had ticked up about 54. So it was putting it right about 9 points, which is much wider than it has been in quite some time, Mr. or Mrs. TAC3. And also, just goes to show that Russell 2000, historically, small cap has been structurally more volatile than large cap, and we're seeing that play out in dramatic fashion. So if you need a quick indicator of the comparative levels of volatility in the two. You can go out, you can pull up the TWIFO report, you can look at the different months at the money implied vol if you want and do that analysis for yourself, or just a quick down and dirty version out there. Go out and pull up RVX. Easiest way to find that. It's kind of hard to find, unfortunately. You got to type in CBOE and RVX to your ticker, and that'll get you to that page where they disseminate that. It's kind of hard to, a lot of your quote platforms don't have RVX floating around. And then VIX is available everywhere, obviously. So you get those two, pull them together. You can do a little quick down and dirty version of that spread yourself. But in general, I think the short answer is much more right now. Sean, anything you want to add here for TAC3, who's got questions about rut vol versus SPY, sir?
Small caps more volatile than large caps. It's not always the case. There are those rare moments, but the majority of the time you're going to find Russell 2000 volatility higher. So it's a great question, TAC3, and we love to talk about it. That's why we bring up the spread every show. So keep the questions coming. Thanks for the question.
All right, speaking of keeping them coming, they're coming. Next up, Zane. Zane wants to know, I see people, including Bloomberg, warning people about USO, even though it's cheap. Why? USO a little bit less cheap today. It was at about a 5 handle as of a little while ago. Let's see where it is right now, Mr. Zane. Yeah, 512 right now, up about 3/4 of a point. It was threatening 4 to the downside. Now up, about almost, not quite a handle, 3/4 of a handle out there. So quite a reversal out there. USO, you're right. I can see how people are starting to look at it. It is very cheap, $4. It's lowest it's pretty much ever been, and at least for quite some time. And looking here at Bloomberg, I think they even called it a tourist trap, which was an interesting term for it, as folks are getting attracted by the very low levels out there. Why people are warning, I've talked dismissively of USO in the past as well. If you want to play in it, make sure it's pretty short term and know exactly what you're getting into. The challenge out there, Zane and everybody else, with a product like USO is it's attempting to effectively replicate a front month WTI future. And obviously, like other products that attempt to do similar things in other categories like VXX in the vol space and things like that, they're inevitably going to have problems doing that because there's a myriad of different ways to try to do that. And the question everyone has is when do you rebalance? When do you roll? WTI, or I should say USO, does it right around 2 weeks before expiration. So what's happening there is, of course, they're selling the near-term vol, and they're buying farther out vol. And what are we seeing out there in WTI right now? Pretty aggressive contango. So they're effectively selling cheap vol and buying much more expensive vol, and doing that over and over again. That generates effectively a very damaging and negative roll yield on this product. Some estimates up there, it's up to 14, 15% right now, if not higher, in a product like USO. So even if you buy it and you're right in overall direction, a day like today you would be, a long-term buy and hold, it becomes more challenging because you have this enormous headwind of this roll yield to overcome, which is eroding this product, like I said, 15% a month, if not more. So that's why people say if you're going to play, a day like today, it certainly worked. It had a nice run. But you want to be judicious in your exposure. Don't just buy it and hold it. Don't just set it and forget it. Get in, get out, get on with your lives. Be very, obviously it's $4. You can say, what can happen? It can only go to zero. I get that. I certainly understand that. But the possibility of it languishing in and around these price levels for some time is certainly there. And if that's the case, it's going to continue to erode as a result of these price yields until we see some very material developments on the crude space. And certainly we're rallying today, but the options are not exactly pricing in a lot of upside joy for the near future. So maybe if you're in it, you take a little bit of your profits, you wait to see what's going on the next day out there in USO land. I, of course, like using the options approach. We always prefer, if you can, if you have a futures enabled account and you have the wherewithal. You listen to a show like this, so hopefully you do. A straight, more direct approach. If you want to play the WTI future, play the WTI future or play the options on that future. Don't try to use some Franken product that attempts to replicate that for people who have securities accounts. And that's what USO is doing. So if you're aware of that and you understand its limitations, it could be an interesting short-term trading vehicle. But beyond that, that's why people like Bloomberg and others are warning people away from it right now. Is just long-term, it's still difficult to prognosticate. And until that sharp contango really mitigates itself out there in the futures, it's going to be a challenge and a lot of headwinds for USO to have to overcome. So it could end up languishing here or even eroding more for the foreseeable future, in which case all you buy and holders not going to be happy. All right, next up. This is a lengthy one from Let's tell you what, let's maybe hold on to this one, and we'll see if we can come back to this. If not, we can't get it on here. We'll get it on another show. That's a pretty long one from Stock Picker 320. Let's go on out to Mary. Mary C. wants to know, why don't you guys spend more time on some of the smaller names on your list that tend to have the most extreme moves each week? Well, I'm assuming, Mary, by the smaller names on your list, you're talking about, well, we have a scenario like today where we have lean hogs with a very extreme move, moving 23% to the downside out here. And yet, you're right, we don't spend a lot of time talking about them. We have in the past. If you want to see why, we'll do a quick repeat. By the way, if you want to find them for yourselves on the TWIFO report, go into agriculture, then go into livestock, and then go on into our old friend, the lean hogs. And you'll see why we don't spend a lot of time, what was the name, Mary, and everybody else out there on these names. It's because, quite frankly, they're not a huge options story. That said, like lean hogs, again, these moves are so astronomical, doing actually a decent clip here this week. It's like 18,000 contracts going up today alone. So maybe we have to reconsider our stances on some of these esoteric livestock names that in the past haven't done a lot of options paper. So tell you what, Mary and everyone else out there who's, was it Mary C., chiming in saying, what about some of the weirder names? Let's get to it really quickly. A little bit of a hashtag hog love out there for you guys out there who like such things. The hogs right now, 44.7 coming into showtime on that front future. The big month, though, from a contract perspective, was out there in June. June hogs doing almost half the paper, 42.4% this week. That was a fair amount of paper, 98,000 contracts on the tape so far this week. So lean hogs, lighting it up out here. And last week they did 80,000 last week. So they're doing some decent paper out here. The big print are the 60 puts, 6,187. 60 puts. That's interesting because those are effectively pretty deep in the money puts. Let's see what's going on out here really quickly if I can get my, there we go. All right, 60 puts. The big print was on Monday, about 2,500, 20, close to the similar number on Tuesday, 2,300, 800 Wednesday, 500 some odd today, total about 6,200 on the week here. Looks like back and forth opening to closings, maybe a big opening print on Monday, and they came and closed it out again on Tuesday. Similar volume numbers right there because the net OI is kind of unched here on the week, slightly opening here. 60 puts, that's a strange one. Maybe also like the 50 puts were also pretty active on Monday, so maybe a bit of a vertical going up there, 60, 50, 1,000 of these 50 puts also going up on Tuesday. Let's see, the number 2 option out there was actually the 50 puts in June out here. So yeah, interesting stuff from an overall paper perspective here in the hogs. Let's see what the vol is like. Obviously, it's going to be moving. This week, the vol is about a 67 out there in that June contract. It's up 17 handles from where it was this time last week. And the skew, in case you're wondering, the puts were super bid, I think is a technical term, last week. They were nearly 37% bid rich to the at the money. This week, they're a paltry 13.9%. So they've come in astronomical amount here. And the calls were 17.2% cheap. This week, 10.4% cheap. So the call is catching a bid, not perhaps as much as you might expect given what's going on out there, but still, the puts also coming in. So interesting stuff out here in the lean hogs, and a little bit surprising, quite frankly. So maybe Mary C., perhaps we were a bit hasty in dismissing, because we've done lean hogs in the past, talked about the hashtag hog love, and of late hasn't been letting it out. Speaking of hog love, Thornton saying, definitely no hashtag hog love this week. Well, we just did some. I get what you're saying. You think the hogs are getting annihilated this week, so there could be no hog love. But, hog love also can translate to us just talking about some of the flow out there and the volume and the volatility. And that's exactly what we just did for Mary C. and Thornton out there. Let's see. Let's do, we got grains. Let's go FX because we haven't done FX in quite some time. Darcy wants to know, can you discuss what CME is doing to fix, I guess pun intended, it's FX options. If you're not an FX person out there, and we haven't talked FX on the show because there hasn't. I talked about the ADV earlier on the show here. There hasn't been a ton of paper out, even though some of the dollar moves have been interesting of late, but it's not lighting up our tape in terms of overall most actives from a move perspective. So you don't get a chance to talk FX a ton here on the show, but CME did announce some changes to the way it's calculating its $13 denominated contracts of late. It used to use 3 trades in the minute right before 9 a.m. here in the Central Time Zone. That was how it calculated the fixing rate for the currency. Things a little bit wider out there right now, a little bit choppier, so it makes sense. They're going to widen that out a little bit and expand it from 3 trades to 20 trades, and that's starting on April 19th. So they're trying to get a little bit more market data involved in that fix price calculation, which makes sense. That's an important calculation. Obviously, it's going to determine what's going on out there, what's in the money, what's out the money out of there in those options. So that's only for the dollar-denominated ones. So you're talking all the 13 that they list over there. So yeah, they're expanding that. If they can't get 20 trades in that 60-second time frame, they're going to go to the midpoint of each bid-ask spread where available and average the resulting midpoints to calculate that fix. And if there's still no trades, they're going to do a synthetic to calculate that fix. So it seems like they're going a little bit farther beyond that displayed liquidity to try to find what they can get to make them more accurate, which makes sense. These things are moving around like crazy out there right now, and there's fewer liquidity providers. Markets are thin, a little wide, so it makes sense. You might want to broaden that time horizon and indeed that trade horizon for how you're calculating your FX fixes out there. Thanks for that. Darcy gives us a little chance to chime in on FX. And last but not least, we got JR. Let's close out, Sean. So you're a positive guy. Let's close out on some love. This comes from JR. He says, 5 stars. Love you guys. Well, 5 stars to you, JR. You're clearly a 5-star listener as well. We love you. We love all of you. Keep tuning in every week because, quite literally, we couldn't do this show without you guys. All right, Mr. Sean. That music means, unfortunately, we've come to the end of an epic journey through the world of TWIFO. Talk some energy, talk some equities, talked a little bit of lean hogs, talks a little bit of FX, answered a whole bunch of your questions, talked about what volume is lighting it up out there right now, and a whole bunch else. But Sean, you kind of mentioned it at the top of the show. You guys have a lot of interesting data on vol and small cap versus large cap and other stuff over there in FTSE land. If folks want to check that out, where should they go? What should they do, Sean?
There's a spot on our website. It's the coronavirus, and it's titled Mapping the Impact. It's a tremendous market hub where we have all types of information that has been written up from some of our best global product market research folks, those being Philip Lawler and Catherine Gashimoto. I think I've mentioned both of their names earlier in the program, but there's a wealth of information there in regards to how to look at the coronavirus and its impact across various asset classes and just things to think about in terms of why certain indices are reacting towards other indices, small caps versus large caps. And it's a fantastic place to look. And if Mark, if I could send you the link and you can broadcast it out to your folks, that would probably be the best. But the website and link on my website or on the FTSE Russell website is FTSERussell.com/corona-mapping-impact. That's how you get to the Corona's Mapping the Impact Market Hub. Do you want me to repeat that?
No, we're way ahead of you, Sean. We're already putting it out there as you speak. So we already got it out in the ether. Before you could even say it. So that's how quick. That's how quick on the draw we are here. Check it out, listeners. I always say to go to FTSERussell.com every week. If you go there, it's right on the homepage. You can't miss it. It's the top thing. Click on that. If you click on that link, it'll take you to that URL Sean just mentioned, or of course you can follow our link on the various social medias and on our website posts and in our show notes. It will take you to a lot of the questions you guys have are touched on in here. Valuations falling sharply. Why is that? Why is FTSE 250 underperforming the FTSE 100? Russell 1000 versus Russell 2000. A lot of interesting kind of analysis here across the board. Drops in sterling, pound sterling. You can get a lot of interesting I'm going to have to spend some time on this, Mr. Steve. Thanks a lot. Now you've pulled me down a rabbit hole of interesting information. Futures and options volume versus volatility. A lot of stuff here to check out. Listeners, that's the place to go. FTSERussell.com. Kick off your time there in between shows. You can check out that. While you're in between shows, make sure you head on over cmegroup.com/TWIFO, because a lot of you guys have questions about a lot of asset classes. As you can see, you can't squeeze them all on the show every week. So cmegroup.com/TWIFO is the place you can go to do your own analysis on whatever. If you want lean hogs, go for it. No one's going to stop you. And if you find something interesting, you have a question about what you're seeing, hit us up. We'd love to hear from you. A lot of you guys have. Clearly, we could do a whole show. Maybe we will do just that, because we have a lot of you guys chiming in. Maybe we'll do some more Q&A specials out there as well. But keep those questions coming. We love to hear from you. Most importantly, stay safe out there. Don't go crazy. Don't go running outside unless you have to. Stay home. Stay small. From a trading perspective, stay safe. And we'll see you back here tomorrow for volatility views. Kick it all off again on Monday with the option block. And we're right back here again on Thursday for more of This Week in Futures Options.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit FTSERussell.com, CBOE.com, and CMEGroup.com. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.